everybody. I would like to welcome everyone to the Fred Report conference call for Thursday, October 7th, 2010. Obviously, we've had some eventful stuff going on in the markets. We've broken out above both the 114 area on the spider and the 115 area. And so it looks to me like we've still got some possibility of higher highs and some more uptrend in place, and I am still detecting a very large amount of negativity out in the market. And the way that translates in terms of the calls I have is people will call and say, well, golly, Fred, you've done pretty well at predicting this rally. I'm still not invested. I really don't want to buy anything here because I know we're going to have a pullback, so I'm going to wait, or I'm going to buy sort of begrudgingly. What that means is we're actually going to probably be able to build up a head of steam into the end of the year, and instead of having a dip in October, as we sometimes do, we may actually have started the year-end rally now. What that can mean, therefore, is we want to be adding stocks to our portfolios and doing whatever you do, i.e. buying funds or whatever, to become more invested. You know, we're short-term overbought on some of the indicators. A pullback to 112 or so would not necessarily surprise me and would not be bad. But, guys, we may not get it. So, you know, it's one of those things where I feel like, and I know how we all feel, the minute I buy, it's going to pull back. So I'm going to wait, in which case it'll go up, in which case I should have bought. But that's the whole cycle people are in right now. So I would say if there's anything that you guys find attractive, technically or fundamentally, you should simply step in and buy it and realize that you may want to buy maybe a half a position or three-quarters of a position and add to it a little bit if we do get a pullback, which we may not get. I think the S&P, the SPYs can make it to 118 or so by expiration, which is next Friday, and possibly even to 120, although 118 is a fairly good stopping point. That would be another 30, 40 points, say, from here. That would not be a huge move and would certainly continue the uptrend. Let's switch ourselves to the bond market for just a minute. Oh, one more thing on stocks, by the way. And guys, I told some of you that dialed into the call early while I was on, I didn't have an internet connection this morning, so this is going to be a little more disjointed than usual. So please ask any questions you want to ask during the question asking phase. Looking at the mid caps, they're starting to outperform again a little bit short term. The long term outperformance is still there. That's an area where you certainly want to be putting some money. I think if I had new money coming in and I already had decent sized small and mid cap positions, I would probably be adding a little bit more to large caps simply because we've had such a big move on the euro that's going to benefit the larger caps down the road, and I think that is a sign, if you will, that large cap stocks may be starting to run a little bit. We're going to take a quick look at the bond market here. The TLT has once again rallied back up to the 106, 107 area and is down, and I'm still thinking that this market can come down and not up into the fall, but as I said, it's a make or break time. If we don't start to break down relatively soon, this is probably not going to be a good trade for us. I'd also mention, by the way, the LQD, which I've always felt was going to lead, did break out above 114, which was a very significant area for it because it was a double top. It's broken that. Now it's down below the 114 area again, but the LQD is actually saying that bonds are going to go up and rates come down. So I'm not holding my breath here, but I still think that can happen, and I guess we're going to have some employment numbers on Friday, and those numbers are going to be significant for a couple of reasons. First of all, and most important, I believe, and Jeff later on in the call can chime in if this is wrong, but I believe this is the last set of employment numbers before the midterm elections coming here. So if the numbers are good, they're going to say the economy's doing a little bit better and the markets are probably going to act well. And if the numbers are really bad, they're probably going to say the economy's bad, we're going to have gridlock, and the market can act well. So either way, I'm expecting these numbers on Friday to be a catalyst for the upside and not for the downside, and that's what it looks like we're set up to do. Bonds, again, on the fence. I would like to see them come down. They may not. Let's take a quick look at the commodity markets here. First and foremost, the DBC, which is the essentially the commodity broad-based index that I follow, is above the 24 short-term target I had for it for a drop into the fall, and but it's not far above. I was using 24. The thing's at 24.53. We're trying to have a little bit of a reversal bar today. Similarly, gold hit 1,300 an ounce, and I did get to 130 on the GLD, and we're having a little bit of a reversal bar today. I continue to like the commodities longer term. I continue to think there's some real opportunities there, and I continue to think that the ultimate resolution of our problems is going to be inflationary rather than deflationary. But we've hit some targets on these commodities such that you want to sell down to a normal position if you are overweight. We'll look to re-enter if these markets come back down in the fall, and if they don't, you're in with a normal position, and we can find a way to add to it down the way. The oil market has traded pretty well, but it stopped at 37 to 37.50. Unless we go above 37.50, there's still a chance for a seasonal drop in the fall. What I would say, though, is looking at some of the oil stocks like Chevron, which has gotten very close to my targets, actually hit my target of 85 already. You know, these are decent-looking charts still in the oils. You want to be adding to this area, with the idea being that even if we get a pullback, this is going to be great in the winter and such next year. Looking at the dollar, I have to say the currencies, I was right on the dollar earlier in the year and simply dropped my position because of the excessive weakness in the euro. And that was that we would rally on the dollar for the year into the 86 area, and we got a little bit above at 88, but that the rally was taking so long that they were actually going to be weaker. Now that the dollar has traded below 79, we're at 77.39 in the dollar index, that can go all the way back to 74, which means dollar weakness, commodities up, et cetera, et cetera. But what we're also going to see is another possible impetus to getting into larger cap stocks, as some of those stocks have earnings in foreign currencies. One stock that's always done very well under those circumstances, it's a great chart, is Coca-Cola, and we'll talk about that in a little bit. That's in the sector charts that I like for that area of the market, which is, I believe, staples.